What's the true value of a company? So if you ask someone now what the true value of Apple Inc. is, that's the phone manufacturer, the person can tell you that the value is $67 billion. But if you ask another person on the same day what the value of Apple Inc. is, the person might tell you that the value is about $3.05 trillion. You see, the difference is large, about 4,000% difference between what the first person said and what the second person said. But guess what? They are both correct, depending on how you look at it. So the first person who said that the value of Apple was $67 billion was speaking based on the book value of Apple. Whereas the second person who said the value was 3.05 trillion was speaking based on the market value. But then the question is, why are there two different valuation figures and which one is more correct? Well, let's start with the first one. So the first one, which is the book value, is actually the accounting of financial value of the company based on its balance sheet. So this is more like the value of the net assets of the company. So if the company decides to liquidate today, if it decides to sell off all of its assets and pay off all its debts, how much will the company have left? That is the book value of the company. And to get that, all you need to do is to take the total assets of the company and deduct the total liabilities, and that will give you the book value of the company. For Apple Inc., that will be $331 billion, which is the total assets, minus 264 billion, which is the total liabilities, and that will give us $67 billion. So the value of Apple Inc. or the book value of Apple Inc. based on its financial statements will be $67 billion. Now, moving on to the second one, which is the market value. So the market value of a company is basically the total value of the company based on the price the company's shares is currently trading on the stock market and the number of shares the company has. And to get this, all you need to do is to multiply the price of the company's shares by the total number of shares the company has outstanding. So for Apple again, that will be $203 because the price of Apple is around $203 per share times 15 billion shares, which is the total number of shares Apple has. And this will give us $3.05 trillion. So based on market value, the value of Apple Inc. will be is $3.05 trillion. So what is the difference between these two valuations? Well, the main difference is that book value, which is the first one I explained, is backward looking. So what this means is that the book value only considers the past financial performance or the current financial position of the company. However, market value is more of forward looking because the market price you see today has already considered a lot of things such as the technology, the expertise, the competitive environment of the company, the growth potential, and other factors in order to determine the fair value of the company, which is more like the market value or the market price the company is trading at. So I'm sure you'll be wondering why you still need to bother about the book value if you can only buy these shares at the market value or the market price. I'm going to use the Apple Inc. again as an example here. So recall we already determined that the book value of Apple is $67 billion. So if the company decides to liquidate today, sell off all assets and pay off all debts, the shareholders are going to have $67 billion left. And for you as an investor, for each share you have, you will get $4.47. And this is the $67 billion divided by 15 billion shares. So that gives you $4.47 for each share you have in Apple. However, if you want to buy these shares in the stock market today, you are going to pay about $203 per share. So if you drill down further using the price to book ratio, you find out that this company's shares is trading at a price 45 times higher than what the financial value of the company actually is. And this usually happens when investors are optimistic about a company in terms of the growth potentials and the performance of that company. So if you're an investor willing to use the price to book ratio to assess a company, you need to do this assessment across time. Don't just assess for 1 year. You need to assess it across time. Check whether this price to book ratio is increasing or decreasing, and also compare this price to book ratio with the price to book ratio of other companies in the same industry as the company you are checking, or other companies that are of the same size as the company in question. And with this assessment, you can now determine if these company shares are overvalued, that is if they are too expensive and they are not worth it. If they are undervalued, that is if these shares are too cheap and you need to buy as much as you can now, or if they are just fairly valued. So now you know the difference between the book value and the market value of a company. This is just one of the things you can consider when picking stocks. There are lots of other factors you need to consider before picking a stock to buy. Let me know in the comment section what are the things you look out for before choosing stocks to buy. Don't forget to like and share this video. Follow for more finance made simple, and I'll see you in the next one.